Is it weird to use 5 credit cards at a gas pump for $1 at a time? Super weird. Even my wife Morgan will be sitting in the car and she'll be like, oh my God, are you really doing that? It's so embarrassing. There's no doubt there are things that make no sense, but it's how the system is built. So the job is to figure out how is the system built, and then how can I proactively use the system to my advantage.
Welcome back to another episode of Wealth Wednesday. I'm Nate Crannell, joined again by Mike Neubauer, CEO of Grand Vision Companies. Mike, I think one thing that is really important in the world of finance to a lot of people is their credit score. Today, I want to talk about credit reports, credit scores, credit repair. You, for example, you've helped people add hundreds of points to their credit scores, as when you were working as a mortgage broker. That's huge. Right? That can be a huge swing, hundreds of thousands of dollars of interest over the life of a mortgage. I want to dive in today and understand how you do that. You were telling me offline before we started recording, you can have a 40-point swing. You can help someone get a 40-point swing in their credit score, which is huge. I want to talk about that, how that works today, why credit scores are so important when it comes to financing, when it comes to getting a mortgage, and why it can be so impactful to your financial plan.
Sounds good, man. Yeah, I'm actually doing this in my own life right now. So I'm going to apply for a credit card. Gives me all these lounge passes at the airport and stuff. So before I do that application for the credit card, I just quickly take a look at my credit report, and I kind of know the back end of the algorithm. And then I just adjust things in my personal credit before statements close. So I know that my credit will be top notch when I hit apply, and it guarantees that I get approved for a card. It works the same way. When I was doing mortgages back in the day for people, before we pulled their credit report, we would always check their current report. And then knowing how the credit scoring works, we would adjust things in their credit report first. And then once those adjustments were made, then we'd pull their report for their official credit score. And I mean, it would be nothing to take somebody's score from, say, 660 to 740. 40-point swing would be, very simple to do on a month-to-month basis. We could bring it 40 points down, or it could be 40 points lower than what it should be. And with some tweaks, we could bring it 80 points the other direction. So a lot of times people look at their credit score and they think like, this is a death sentence. My credit score is 620. But the reality is that 620 could be 720 literally within a month if you know how to, handle things on a credit report.
Yeah, so let's talk about that. Let's say I'm going to get a mortgage. Well, yeah, I'm going to go get a mortgage, $700,000 mortgage. I sit down with you as my mortgage broker, and I'm saying, hey, my credit score is like 680. It's not the worst, right? We're not the bottom of the barrel, but it's not great. What's kind of your first steps? What are some of the things that you're thinking about to make that 40, 60, 80-point swing in that 30-day time frame before I go get pre-approved?
Yeah. So first of all, I just have to say this. The sad part is most mortgage brokers will not have this understanding. They don't know how to do any of this on the credit repair side. They wouldn't even know. They would just think it's 680, it's 680. And the other thing is most are chomping at the bit to get that commission. So they're going to pull your credit right away and try to get you rocking and rolling in the process right away. That's the downside. That's why we do these episodes, because really it falls on you to be prepared and know how to do this so you're not guided inappropriately by a mortgage broker or somebody. So you want to make sure you understand this first, so they don't say, let's pull your credit, and you say, okay, yeah, let's do it. Okay, I saw this episode. That's not what we want to do. We want to preemptively boost that score first before we do this. So to answer your question, some of the main things we're going to look for right away. Number one is any derogatory marks. So derogatory marks are going to be late payments, collections that are on there, potentially foreclosure, bankruptcy, but typically it's going to be late payments and collections are going to be the things that are just small enough that they reduce the score, but super easy to fix at the same time. And that's really going to be where we focus on initially. So if there's derogatory report or marks on there, it's going to take more than 30 days typically. 30 days will be about the minimum to clean those up. 90 days will be about the maximum. So that's the time frame. So the sooner you take a look at your report, the quicker you can start working on it. And then worst case scenario, 90 days, I'm going to clean this up. Best case scenario, 30 days. If you don't have derogatory reports, then we're going to be looking at balances. So which way do you want to go first? You want to talk about derogatory marks and how to remove those? Or you want to talk about you don't have derogatory marks and you want to boost your score 40 points before you pull the credit.
Yeah, let's talk about derogatory marks, because that could be a common thing where somebody missed one payment. Maybe they have some student loans, from back in the day. They missed a few things. I think that might be more common. Where's kind of your go-to? If somebody's looking, they know, okay, I've got a few things on my credit. Mike's already asked me to take a look at my credit, and he's going to help me out. Where are we going? Are we going to a credit platform like Credit Karma?
Yeah, so we would use Credit Karma initially to pull your report. Credit Karma is just a quick, easy one. They do obviously give it to you for free because they want your information and they want to sell you offers and try to get you to apply for a credit card. So that's how they make their money. You can go to annualcreditreport.com. It's a little bit more cumbersome, but that is the law that annualcreditreport.com has to give you one free copy every year of all 3 bureaus. So you can go there. It's just a little bit more cumbersome to get your Experian, Equifax, TransUnion, or just go to creditkarma.com, set up your account, and then you can review your report at any time, on any day. Just don't click, yes, I want a credit card, and fall for all the offers, because that's where they make their money.
Yeah. All right. So I go to annualcreditreport.com. I get my one annual free report, and I've got a few derogatory marks, right? I had a credit card payment from 2017 that I missed 2 months in a row. I have some student loans that I didn't pay for a little while. I didn't know that they were up and running again. There's some derogatory marks. What are some things then that you're talking to me about to fix some of those?
Yeah, so I have my own set of letters that we worked with an attorney to draft up, and this is from the Fair Credit Reporting Act. So there's just a set of letters that needs to be sent out. So the easiest thing, I can't do it because I'm not an attorney, so I can't do it for somebody. But the easiest thing is 2 ways. So you either just go to a credit repair company. They have all these forms. They have an attorney on staff that can legally fill out forms for you. They send them off. They run the exact same program as what we run. The other thing is I just have these letters, so I do it myself if I were to have anything on mine, or I just give these letters out to like family and friends and say, hey, here's the process. Here's how it works. I can't fill these out for you, but these are the templates. You're welcome to use them however you want. Actually, we had the 5-day challenge. We'll throw that as a bonus. So we'll include those letters and that instruction template as a bonus for the 5-day challenge. So it'll really be like a 6-day little bonus. So if anybody has credit marks, they don't have to hire a credit repair company. They can just run this. But basically the way it works is the credit bureaus, there's 3 main ones. They are private companies. And what they get paid to do is to collect data and publish accurate data for people. Now, when a creditor, let's say Chase Bank, says you missed a payment on your credit card 3 years ago, you were 30 days late, they report this to the credit bureaus. Sometimes they don't report to all 3 bureaus. Different cards sometimes will not report to one bureau. So you might have something on one report, but not on the others. That's why. But they say Nate was 30 days late 2 years ago in January. So that mark is on your credit and it shows, and it is going to affect your score. Basically, the way the credit repair works is you send a letter to both Chase and to the credit bureau, and you say, listen, there is a 30-day mark on my credit report. By law, you have to send me proof that I was actually late. The problem is the credit bureaus just take Chase at their word. They don't actually collect all this proof. It'd just be too cumbersome to always collect proof. And Chase doesn't have the resources to go ahead and find this proof from 2019, whatever, in January. So they don't really care. They're not sending proof because it's too much of a pain. So the law says both of these people have to have actual proof that you were late. Neither side really wants to commit resources to proving it. So you send these letters, they just remove it from the credit report. Now, sometimes they will automatically send a letter back that says, we do have proof on file, we're keeping the 30 days. Then we have a follow-up letter that says, it seems very hard to believe that you have proof. You didn't send it. Chase Bank also did not send proof. Nobody has actually sent me the proof. Please review it and send me actual proof or remove it from my credit report. In general, this is, what the letters say. Typically at that point, 60 days in, sometimes 90 days in, because they have to respond in 30-day increments. So they'll usually wait the full 30 days, then you get this automated letter. But around that point is then when you get a letter that says, this has been removed from your credit report. Sorry for the inconvenience.
And that can be what type of debts are sitting out there, what type of derogatory remarks can you send these letters to? Are there some that you can't? Like, is there sometimes where you're looking at a report and it's like, hey, sorry, like that's just something that I can't overcome? Or are these types of letters pretty holistic as far as the debt that are shown on credit reports?
So typically, you could do everything up to a foreclosure or bankruptcy, but those are going to be much more difficult to take care of. A late payment, typically there's just not enough resources and nobody wants to spend the money to prove a 30-day late payment 4 years ago. So those are going to be much easier. Those are what we'll see drop off in 30 days a lot of times. Now, if we have a bankruptcy or a foreclosure, that's going to be much more difficult. That's going to be a lot more legal back and forth trying to prove that something was missed, because a lot of times that is legally proven and that's out there. It's not impossible to remove those, but they're much more difficult. Something like a collection from an old cell phone bill, a collection from an old utility, a 30-day late payment, a missed student loan payment, those are so minute that nobody wants to spend the money to prove that those were real. So they'll just remove them from the credit report.
You know, those 3 or 4 things you just mentioned, how impactful from a score standpoint are having those derogatory marks? Let's say you had one of each of those that you just mentioned on your credit report. How impactful is that to the credit score?
So they're more impactful the more recent they are. So as time goes by, they carry less weight. None of the bureaus publish their actual algorithm and their data to say this is exactly how we calculate a score, but we do know in general how things are weighted. So carrying high credit limits or high credit amounts compared to the limit is going to pull your score. A lot of hard inquiries recently is going to pull down your score. Having late payments from the past, if they were last month, it's going to carry a lot more weight than if they were 5 years ago. So this is all an algorithm, and all these bureaus use this. Something like Credit Karma, they're using their best guess at what the algorithm is, because there's a lot of data out there, so we can get a best guess at what they're using for the algorithm. But the more recent these derogatory marks are, the more weight they're going to carry. Stuff like late payments, a 30-day is going to be less intrusive as compared to a 120-day. The problem that comes in is if you missed a payment, let's say 5 years ago, and you missed one payment, but you missed it for 120 days because let's say you moved and you forgot about that, it wasn't on auto pay, you didn't see that payment come, you missed it for 120 days, you now have a 30-day, a 60-day, a 90-day, and a 120-day. So you have 4 months in a row that show different derogatories. It's the same missed payment, but it's 4 different marks on your credit. So that's going to carry a much greater weight compared to, you know, a 30-day one time 5 years ago.
I mean, that just sounds scary, right? So, I mean, the 5-day challenge, the 5-day financial challenge that we're putting on was already going to be a huge impact, right? With all of the content and all the information and the statements and the knowledge that's coming with that. To add these letters that can potentially change those derogatory marks, adding that in there for free is that's a no-brainer. You have to go do the challenge now, even if it's just to get those documents. That's going to be it's going to be a big win for people who participate in that.
Yeah, I mean, people care about their credit score kind of from a pride standpoint, but most importantly, this is what I always tell people is besides just what your score is to tell somebody, that score is a big financial impact in your life. I mean, if you're buying a $700,000 house and the difference of your rate is 6 or 6.25, that 0.25 on $700,000 over the next 30 years is a huge amount of money. So people are focused on trying to make more money, trying to find a way to get a lower interest rate. I mean, sometimes just something as simple as sending some letters and adjusting your credit report could be a 6% instead of a 6.25 and mean literally tens of thousands of dollars over the course of that loan. So, I mean, it has real financial impact besides just being a score on a paper.
For sure. All right, let's talk about the other side of things. You know, we kind of covered the derogatory marks, and I think that was good insight and analysis by you to understand, okay, you see your score, you see the marks, how to correct it. You know, there is a course of action to get that taken care of. You've now waited the 90 days. You pull your credit report again, and it's now fixed. What are next steps now?
Yeah, so when we're doing the derogatories, we're just going to be looking at something like Credit Karma because they'll give us an update. When you send these letters, they are required to send you an updated version of your credit report. So you do always kind of get that feedback to see, has it been removed or not? But Credit Karma is nice because it'll check every day. So you can always check. So before you do a hard inquiry with a lender, whether it be a mortgage or a car, you can go to Credit Karma and see, has my report actually updated with this new information? Because sometimes, like a credit card, for example, it won't post new data until your statement closes. So it might be fixed today, but your statement doesn't close for 20 more days, and that won't update until that 20 days and it actually posts. Most people fall in the next boat, what you're talking about. They don't have derogatory marks, but we want to be able to swing that credit in the right direction. So what people don't realize is a lot of people will pay off their credit card each month. But sometimes that balance, when the statement posts, that balance may be almost at the credit limit. Let's say you have a $15,000 credit limit and you use $12,000 of that. You pay it off each month, but you're using $12,000. When that statement posts, it will show that you're using $12,000 of a $15,000 credit limit, which reduces your score because they're saying you use a lot of this credit, and because you're using a lot of this credit, we need to reduce your score a little bit. Versus if you had a $15,000 limit and you had a $0 balance on that credit report. That is where we can get a swing of, say, 20 points low and all of a sudden go 20 points higher than where we currently are because we can adjust where that is. So in that scenario, we would look and say, this credit card, the statement closes on August 16th. Well, we're going to pay the balance on August 15th. So when the statement closes tomorrow, it shows a $0 balance versus waiting to pay the card on August 17th, because then when it posts, it's showing our $12,000 out of $15,000 balance. So little tweaks like that is what we're going to do. And we're going to look at every account. When does it post? And can we pay this down before it posts to the credit?
Gotcha. And then are you advising individuals then they make that payment on the 15th? Statement posts on the 16th, shows a $0 balance. Is that when you're saying, hey, now's a good time to go in and make that hard inquiry with a lender? Is it wait 30 days, like try not to use this credit card for 30 days so that we can get one more cycle in of a $0 balance? What's kind of the advice there?
Yeah, so typically people have more than one credit card. So typically they'll have, let's say, 3 credit cards, and they're all going to have different closing dates on the statement. So we're going to look at all those accounts. Somebody could have a home equity line of credit would be another example where we can adjust down or up. So we're going to look at all those different credit cards and see when did these close. And we're going to try to line them all up. So one closes on, say, the 16th. One closes on the 20th. One closes on the 23rd. So we're going to preemptively pay all these off right before the statement closes. And then once all of these report, so now we're at the 23rd, all 3 credit cards have reported a $0 balance. Now on, say, the 25th is when we're going to pull that hard inquiry. But we're going to check Credit Karma first to make sure that that statement has posted and actually shown up on the credit report. And now you'll see on Credit Karma, because they show you a graph, you'll see all of a sudden a shoot up in your credit score. And you know now that there's $0 balances on those credit cards. So I just wanted to share a quick update on the credit score. We said we'd put this back into the episode. This is from the credit scoring Wealth Wednesday episode I did with Nate. So here is my credit score. This is on August 15th of 2024 is when we recorded about then. So you can see my credit score at that time was 663 on TransUnion, 667 on Equifax, and this is done through Credit Karma. Now the purpose of doing this was to show you how easily you can raise your credit score just by understanding how credit scores are calculated. So what I did is I allowed my balances on my credit card to post on their statement like they normally do the previous month. And by allowing those balances to post, it pulls the score down a little bit. All of my credit cards, the statement dates are between the 17th and the 21st of the month. So this was on August 15th. If you can't see the screen on YouTube, then the score is 663 and 667 on August 15th. All I did on this day was I paid down the balances on all the credit cards. So what people normally do, what I normally do is once the statement posts, it tells me the full amount, and then it's on auto pay to just pay off that full amount every month. But by preemptively going in and paying the balances down to 0 before the statement posts, so all I did was pay 2 days prior to what I normally would, but by paying that balance as 0 and having that balance then post as 0 versus the balance that it was previously, this is what it does to my credit score. So this is August 15th. Now we're going to look at August 21st. So all it is 6 days later, I prepaid all of my credit cards the day before the statement post. And this is what it does. It brought my credit score up on TransUnion 136 points to 799. On Equifax, it came up 143 points to 810. So a huge swing. In the episode, I said that my assumption was that I could raise it by 40 points by doing this as an example. My example actually ended up being almost 140, while on Equifax it was 143 points. So 136 and 143 point swing in 6 days by doing nothing except for understanding how the algorithms work and how credit scoring works, so that I can take advantage of how the system is set up and ensure that I have the highest credit score. So what you want to do is, if you're going to be doing any sort of borrowing, if you're going to be buying a new car, buying a new house, anytime you're going for a loan, all you want to do is hop in and check your credit score before you ever go talk to the bank or the lender. If it's above 720, 740, there's really not a huge benefit to raising the score more. But if for some reason your score is at, say, 718, maybe it's down in the 660s, 680s like mine went, you want to make sure that before you go talk to that lender, you control your credit score. So you're going to look at the date that the credit cards post. You're going to check your credit report to make sure there's no late payments or anything that were on there. But what you really are going to do is just see when your credit card statements post. If they post on the 17th, the statement date says August 17th, when that posts, then you're going to prepay that credit card on the 16th instead of on the 18th, and then allow that to post to your credit report, and your score will shoot up. So you want to just make sure that you control your score and that you know the exact score before you go talk to a lender. Because once you talk to a lender and they pull that credit report, that score is somewhat locked in stone. And even if it's not locked in stone and they do a repull to raise the credit, those hard inquiries start chipping away at your credit score. So you want to do all the legwork up front. You want to understand how a credit score works and make sure you're in control before you actually go and talk to a lender and allow them to pull your credit. I am super excited to introduce to you the Doctors and Dollars 5-Day Financial Challenge. I'm Mike Neubauer, I'm CEO of Grand Vision Companies, and I'm the one that you see on the Wealth Wednesday and Daily Dollar episodes with Nate. So Nate and I are partnering again to do something even more exciting, which is the 5-Day Challenge. We're taking the best of all of our episodes, all of our expertise and knowledge, and we're condensing it into an impactful and purposeful 5-day presentation, 1 hour per day, for 5 days, to give you everything you need to build that foundation for your financial future. So if you're looking to gain the pieces, you want those puzzle pieces and find out how they fit in your financial plan, head over to the Doctors and Dollars website, join us on the 5-Day Challenge. We're putting it together for free, so you got nothing to lose. We look forward to seeing you on the inside.
I'm curious. You had said earlier, like, most mortgage brokers are not going to know a lot of this back end knowledge that you have. Obviously, you've done a ton of research. I know in conversations with you, you've helped a ton of people, clean up their credit score before they go out and get that financing. Why don't more, like, I know they're compensated on the close, right? A mortgage broker is, but why wouldn't they want to help, their clients a little bit more, get a better rate, get that 6% versus the 6.25? Or is it just simply, hey, I'm trying to, put food on the table every 30 days. So we need to close this as soon as possible. I don't really care what rate you get. It's not my rate.
So, I mean, at the end of the day, everything is incentive, right? So if there's enough incentive for that mortgage broker, they would gain this knowledge. The reason they don't is there's no incentive to them. They're getting paid a commission on the loan amount. So whether you get a 6% rate or whether you qualify for 6.25, they're getting the same commission. So what is the incentive to them? It's to close the deal. It's not to get you a lower rate. And if we chance that waiting 30, 60 days, I lose you as a customer, I don't get that commission at all. That's just too risky and there's no incentive. Why did I do it? I did it because I do real estate for myself. So I wanted to make sure that my credit score was top notch, because when I do a mortgage, when I go get lending, the credit score is my actual credit score and it financially impacts me. So the incentive is extremely strong for me because I'm not getting paid a commission. It actually is affecting me for the next 30 years. So that's why I dove into this and learned all about it. The reason that I help people on the other side is when I was doing mortgages, a lot of times people would be in a rent to own situation in one of our properties. So we wanted to sell a property. They were renting it already. The easiest transition for us to sell that is not kick them out, but help them qualify to buy the house. They don't want to move. They like it. They want to qualify. Their credit doesn't help them qualify. So we would help them qualify. Now we're going to sell the house with 0 days on market because we're collecting rent up until the day they actually can buy. They're going to be able to actually qualify now. We don't have any realtor commissions coming out of our profit. So if we sell a house for $300,000, we're not bringing $270,000 home at the end of the day because realtors collected all commission. We're actually getting $300,000. So again, the incentive to help these people was a win-win. They couldn't qualify otherwise. We were going to get more money in our pocket because we're not paying more middlemen out the money. So it was a win-win to work with people and say, hey, here's these letters. I would highly suggest that you write these letters and use it to clean up your credit so you can qualify. You know, people thought they'd be renting for years. Within a 90 to 120 days, they're qualifying for a mortgage that they never thought they could qualify for. So it just comes down to, is there enough incentive to actually go forward with this? For us, there was, which is why I went down that road and really wanted to understand, how does this work and how do credit repair companies work? Why does a credit repair company exist? What do they know that I don't know?
That's a good light bulb moment, maybe for physicians who are getting interested in investing, right, into real estate. You know, they don't, maybe not looking at their credit score very often just because they already have their own primary residence. You know, they pay off their credit cards. They feel like their credit score is pretty good. They don't really look at it, but maybe they should be. And they want to go invest in some properties. And then this comes up. And then now they have this whole circumstance that we've been explaining during this episode. You know, I think it's really important that everyone is aware. How often do you typically recommend to people to look at their credit score? Not necessarily even if they're wanting to, they're trying to make some type of financial decision, but how often should they just be aware of it and look so that if some type of opportunity does come up, they don't miss out on it, to say, hey, you know, I was approached with this type of deal. It's really great. But then I peaked at my credit score. I really need 30, 60, 90 days to be able to fix this before I can participate in this deal. But by then it's going to be gone. So how often should people be looking at their credit scores to, I guess, proactively get ahead of having to send those letters?
Yeah, I think some people focus on it too much. They're like checking once a week and the numbers sway. I mean, I'm telling you, we can go 40 points low to 40 points high in a month. And people will focus on this like this number is set in stone and it's so hard to move, and they get dead focus and it drives them nuts and causes anxiety. So definitely not that often, especially if you're not looking to buy something in the near future. I would say probably quarterly is what I would be looking. Roughly every 3 months, you just log on to Credit Karma, take a quick peek, make sure it's all good. And then in 3 months, put it on the calendar and you can check it again just to make sure that nothing slipped on there. You didn't have a credit card bill that you thought was on auto pay and you missed. You didn't have a student loan that switched servicers and the auto pay didn't switch with it. So now you all of a sudden miss that payment. Those things happen all the time. They're out of your control. You can have everything set up, but your mortgage payment gets sold from Wells Fargo to Freedom Mortgage. The auto pay didn't switch over with it. You didn't know about it because you were out of town. And all of a sudden you have a 30-day late on your mortgage. You want to catch those things before they get too far out. And now you got to do this whole process. The other thing I would highly recommend to people that are passively doing it is, if you don't need your credit today, what you want to do is once per year, raise the credit limit on your credit cards. So you want to have a few credit cards. A lot of people only use one main credit card, but they have a few from the past. So what I do is I take my past ones. I've done this for a long time. So I have like 15 past credit cards. You don't want 15 brand new ones because then your history gets very recent. And they say your longest card, the average is only, say, 2 years, which hurts your score. But the credit cards that you have from the past, I put them all in a folder, one little folder, and I'll go to the gas station, and I'll just put it in, pull it out, fill up a gallon of gas, put the next one in, pull it out, fill up a gallon of gas. I'll do this once a quarter, say, sometimes only twice a year, just to keep that card active and reporting to the credit as an on-time payment. So that's what I do passively throughout the year, just to be proactive. And the other thing I do with each of those credit cards is once per year, I'll request to raise the credit limit, because everything is based on percentages. So if I have a $10,000 credit limit and I have $1,000 on that card, I am using 10%. If I can raise that credit limit to $20,000, now I'm only using 5%. And the algorithms are based on percentages. So I can either lower the amount that I have on that card, or I can raise the limit. They both have an impact in the positive direction on the score. So if you're not looking to use a credit right away next week, we'll do that once a year, is go to every credit card and just request a credit limit increase, because whether we go down or we go up, it has the same benefit. So if we don't need to worry about going down, we just proactively keep raising that limit as much as we can, and that'll improve the credit score naturally.
I was just, as you were talking, I was trying to picture you at the gas station down the street from your house, like pumping 1 gallon of gas, swiping the next card, and the car next to you is like, what is this guy doing? What a weirdo. But hey, I bet if you turned and said, hey, I'm raising my credit score right now, they might have some questions for you.
I'll tell them, watch this episode. You'll find out why.
There you go. Absolutely.
So, no, there's no doubt. I mean, even my wife, Morgan, will be sitting in the car and she'll be like, oh my God, are you really doing that? It's so embarrassing. But the reality is, this is just how it works. It is, there's no doubt there are things that make no sense, but it's how the system is built. So the job is to figure out, how is the system built? And then how can I proactively use the system to my advantage? Is it weird to use 5 credit cards at a gas pump for $1 at a time? Super weird. But it's going to raise my credit score by showing proactive use of these cards, on-time payments on a regular basis. It improves my credit score. It's just the way the system's built. I'm going to use it to my advantage, so that's what I recommend to everybody.
Yeah. I mean, I've never thought of that, but I mean, that makes perfect sense how it works. If you understand what we know about the algorithms, right? They're not out there publishing saying, here's all the data points that we specifically use at what time. That's tough. But like, just knowing how it interacts with transactions and steps that you take. To do it twice a year, that's really not a big deal. Go do it at 10 o'clock at night when nobody's really around, and you'll feel less weird. But I think it's really important. Let's talk about some success stories. I said earlier, you've helped so many people adjust, change, repair, if you will, if you want to use that in quotes, their credit score. Give me a couple success stories of saying, hey, I helped this person secure better financing, because we took some of these steps that we've been talking today to make that 30, 40, sometimes 80 point swing in their credit score.
Yeah, I mean, so we got little success stories and big ones. I'll give you a little one as just a silly example that this would apply to people that don't even knowingly do this. So I told my dad, use these credit cards in the same way. Just throw a couple dollars on it every now and then. Keep them active. Well, he did that with a card, but he forgot that auto pay was not scheduled on it. And he forgot to pay it because it wasn't on auto pay. It was just $1. He never pays that bill. So he just forgot about it. It turned into a 30-day late mark on the credit report. So that's something simple that was not meant to be wrong. It was meant to be used correctly. It was just a mistake that got missed. So we're able to go and just send these letters and correct that mistake on the credit report and that derogatory. So it just cleans it up because it was a total mistake. So some people just have that total kind of mind forgetfulness. You miss one time, you have that, and you feel like, oh my God, now I have this on there for 7 years. We can just fix that nice and easy. So that's one just basic success story that somewhat happens on a regular basis where I know somebody that just forgot. A major success story is always the people that did the rent to own from us. So they would move in, they think they're renters for life. We tell them right away, hey, have you considered a rent to own? We'd be willing to sell this house. And they're always saying, my credit's terrible. I talked to a mortgage broker. There's no way. I'm not going to qualify. I'll pull the credit and take a look at it. And I see that, we can clean this up very quickly. Most people think they're stuck in, say, a 3 to 7 year time horizon. Maybe they just had a bunch of missed payments. They lost their job 6 months ago. They got a new job now, but while they had that 6 months off, they racked up all these late payments on their credit report. So we can run them through, and within that 12-month term of the lease, they're buying that house. So then when you go to the closing, they're in tears. They can't believe that they could ever buy a house because they were told that it'd be years before they could. So those are always the best success stories, and that happened a number of times. We hold properties now longer, but for a long time, we were doing a lot of rent-to-own type situations where we'd rent it to them, and then hopefully they could buy it. So those are always the best success stories when you're sitting at that closing table 12 months later, and these people are just ecstatic because they got an opportunity that nobody else even told them existed. They had no idea that this would ever be possible, and now they're actually living it. So that's awesome.
Yeah, that is cool. I mean, what a feeling to I gotta imagine that tears are at that table, as they're signing closing documents, just thinking that, hey, I don't ever have to sign a lease again because I'm a homeowner, which is always a great feeling to have. From a financial perspective, if somebody's renting from you for $1,200 a month, and they then close on this, is their payment similar, or is it, hey, you've helped with the credit, and so like maybe their payment's even lower, they got better financing than they ever thought, and so now it's like their mortgage is $1,100 when they were paying $1,200 in rent? Like, talk to me about some of the finances behind those wins.
Yeah, those are always going to be a little bit different. So the markets are always kind of adjusting. So right now, mortgage payments are typically higher than rent, just in the situation we're currently at with high interest rates. But back then, rents a lot of times were going to be higher than mortgage payments. So you'd rather have a mortgage because it was cheaper. But every scenario is a little bit different. But the higher we can raise the credit score, the lower it brings that monthly payment. And the closer we can get it to the rent, the better it's always going to be. And then when you're qualifying for the mortgage, they want to see past rent on time. So they'll look at your history to make sure you paid rent on time as kind of another checkbox. So that's always helpful to show, I've already paid 12 months of this payment. That just proves to the bank that you can afford to pay that as a mortgage payment, just like you have as a rent payment in the past. The big wins come for the people who are just going to, as far as the monthly payment marks and how that translates, that's for the people who walk in and they have 714 credit score. Great credit score, 6 points below where you're going to kind of get that next dip. So they go in 714, they're like, this is great. They go forward, they get the mortgage. Well, I could look at that and say, we're 6 points away from a 720. That 720 on the chart is our next drop in rate. Let's just clean some stuff up here. Let's pay down a credit card before the statement closes, and we'll bump to 730, and then we'll pull that credit, because that's where we're going to get a slight increase or a slight deduction in the rate, where it goes, say, from 6.25 maybe down to 6, or maybe they qualify for a different lender that they would not have qualified for without that 720. And this lender always has better rates, but they only take top borrowers. So we have a lot of tools in our toolbox that we can use if we meet these requirements. So that's where you're going to save somebody. You run it on an amortization schedule over 30 years. I mean, it is tens of thousands of dollars. And a lot of people focus on a monthly payment. They'll say, oh, that was only a $40 reduction in monthly payment. But if you look over 30 years, it could be $60,000. And I always equate it to the people who say, like, I need to pay for my kids' college. I need to start saving. It's like, if we just get your credit score above 720, over the term, that'll save you $60,000 of real money that you can apply to anything. But people don't like to look at it in that long-term viewpoint. And it's like, your kid doesn't go to college in 10 years. Over the next 10 years, this reduction in the rate will save you 60 grand in interest. That's a whole year of college right there, maybe 2 years, depending where you go.
Yeah. Well, I'm going to ask the question now, and you probably see it coming, because I guarantee you all of our listeners are thinking it right now. Is you just mentioned that there's a tier that starts at 720 credit score. Being at 714 puts you in a different tier. Can you talk about those different tiers? What are those credit score numbers that get you a better score or a lower score? What's that tier system look like?
Yeah, so occasionally 740 will be a tier. Very regularly 720 is the tier. And then the next tier down would be 680. And then as we drop lower, you start to get to a point kind of below a 620 where you almost don't qualify. The rates and the fees are going to start to increase so much. When I say fees, it's hits to the rate based on the terms of what your credit score are. So maybe the base rate is 6%. If your credit score is 605, you're not getting 6%. You're going to pay closer to 7. Now, if the base rate is 6%, that means you might need a 740 credit score to actually qualify for this 6%. And the rate fluctuates based on these different terms. So if you're an owner occupant of your home, you're going to be in the best qualification because they figure you're going to pay your payment on where you live most likely. Now, if your credit score is 740, then you're going to get the best terms, the best rate. Everything is going to be the best. As we start to move down, then we're going to have a higher rate based on what we need. So 740 occasionally will be like top tier with certain lenders. Oftentimes 720, 680 to 720 is typically where I want to work with people because that jump is very easy. it usually doesn't require derogatory remarks getting removed. It's usually a credit usage ratio, and that's what we got to reduce the credit versus credit limit, and we can get from, say, 690 to 725 or 714 to 730 to qualify for that next jump in rate. As we get lower into the low mid 600s, typically that's going to have a derogatory mark or something that we have to qualify and get removed. But there's a lot of loan programs at 620, 680, 720, sometimes 740, these different ones. And 1 point below means you're in that category. If you're at 719, you just don't qualify for the 720 plus box on that chart.
Wow. Yeah, I guess I just didn't even realize. I know what's the highest? 820 is the highest credit score you can have, and then
Equifax, Experian, and TransUnion have different ones. So when we're talking about a credit score, typically they'll pull a tri-merge report. They'll pull all three, and then they'll combine those reports to give a final score. But each one will give actually a different score based on their own algorithm. But yeah, for sure, people don't realize that. They shoot for, let's say an 800 credit score, but an 800 credit score doesn't do anything more than what a 740 would. But a 719 versus 721 actually makes a big difference. And somebody looking at their friend who has a 721 and theirs who has a 719, they think it's so close, that's no big deal. But the 721 is closer to the 800 than they are to the 719 when we're looking at the chart and what you pay in actual interest rates.
Yeah, that's wild. Hopefully that's kind of a light bulb moment for people, because you're right. That's 2 points difference, but when you're looking at the tiers and what that truly means from an interest standpoint, when you are getting financing, it's a big difference. And from everything that we've talked about so far today, it's not terribly hard to go out and get that fixed. So we mentioned it earlier. If people want to go out and look at their credit score, creditkarma.com does it for free. Annualcreditreport.com gives you one free per year. As soon as you listen to this episode, close out of your app, go look at your credit score. If you have questions, reach out to Mike and I, grandvision.co. We have a contact us tab at the top. Reach out to us and ask any questions you got, because as you can tell through the last 30 minutes, Mike knows what he's talking about. He has proven experience to be able to handle a lot of these situations. He's seen a lot of different things, and it's truly just the tools and the resources ahead of you that can help you change your credit score and save you thousands of dollars in the long run. Final thoughts for you, Mike?
Final thoughts. One more tip that most people forget. We run real estate, so we see people. We have a property in Cedar Rapids right now, close to a college. A lot of college applicants. They're 18 to 22 years old. No credit. So their score is terrible because all they have is maybe one hard inquiry and they have no actual proof. So the best thing you could do is put your children on as an authorized user. So you can't miss a payment because that will affect their credit as well. But my kids, I just use the credit card that has the longest history. The first one I ever got, it's a Chase Southwest card. I got this card. I added my children as authorized users. The credit card comes, I don't use it. I just cut it up. But all of my reporting from that day forward, when I use that card, goes onto their credit history. So they're building credit from day one. By the time they turn 18, they will have actual credit report and history. So when they start applying for things, if they want to get a loan, if they want to buy a house at age 21, they actually will have some credit history. And then when they turn 18, we will apply for a credit card with a low credit limit, but so they can start building actual credit owner reporting as well. So right now they'll show as an authorized user on all mine. It's starting to help their credit. And then when they turn 18, we don't just give them a credit card and say, here it is, but we apply for one and we do like the gas station pump thing to show on-time payments over and over. And by the time the kids are 21, they have a 700 plus credit score instead of starting at age 22, finding out they have no credit and now they have to start building. That's something that you can give a huge leg up to your children. So when they turn 18, they're already years ahead in building their credit.
Man, powerful insight there. That was really good. People are going to hear that and be like, oh, Mike, that's genius. So that's really good. It's a great segue. We're going to do another episode on money education and money tips and tricks with your kids. So I think that's going to be a good segue. We'll make sure we talk about it in that episode, but stay tuned, because the education that you provide to your kids today invaluable for their future. Again, I think so many people just pay for things for their kids. They don't teach them anything. Then you got an 18-year-old who gets a credit card. You have a 22-year-old who is, out on their own and trying to figure out, okay, I want to rent, I want to buy, do all these things. And they just don't have the money experience. They don't have the education and understanding. And then to your final point there, they don't have the credit score to do it. So I think that's super valuable. We'll be back with that episode sometime soon.
For sure. And like I said, I'll throw those letters in the template. We'll throw that into the 5-day challenge as a bonus session, kind of like day 6 follow-up. So if you want to learn more about, this is kind of the medium level, it's above beginner, but there's more advanced stuff that we can't just do in a 30-minute, session, but we'll throw that into the 5-day challenge. So we can include that if they do the Doctors and Dollars. What is doctorsanddollars.co/5-day, I believe.
Absolutely. Until we meet again.
All right, buddy. We'll see you.